Okay, trading idea in gold that I told you I would produce a video or a post about. So here it goes. What we're looking at doing is going out to April expiration, which is just around, in terms of time, it's right around this general area. So what we're looking for is for gold to bounce and bounce up towards basically these recent swing highs. So, a relatively small bounce and not that big of a deal. So, by April expiration, we need gold to trade up to, let's call it 1700 to make it easy. So, 1700, this is where you need gold to be price wise by this date. Now, with that said, if it's anywhere above those levels before then or at those levels before then, you can feel free to take this position off whenever. So our thesis for this trade, and I'm not going to, well actually I will introduce to you what we're doing. We're doing the 161, I'm going to type it so you can see it. The 161 by 164 April call spread, and I bought it for $1.10. So what that means is you're spending $1.10 to make a potential of $3. So your risk reward is about a 3-to-1, which is in my opinion, a good risk reward ratio, one that you want to, that you can operate with. But the best part about this is you will not lose $1.10 on this trade if this position goes against us, unless if you let it. And the reason why is because we sold this 164, and I'm going to bring up the actual spread so we can explain it better. Okay, and we're going out to the April monthlies. We have 22 days, and the 161s currently trading for about $2.40, and the 161s by 164s. Okay, now they're trading for a dollar, call it $1.20. So what we're looking for is basically if this position goes against us, this short call that we have, that's currently trading at $1.24, that's going to help protect us from the downside. And so if this position doesn't work out against us and gold starts to fall below, you're going to see that short call start to be profitable while the long call goes in the red. Now, the long call's going to fall more than the short call, but that short call's going to help hedge. So we're giving ourselves 22 days to let this position work out, and I feel very comfortable because we're going against March's point of control. We have basically a 7-month point of control on our side. And I'm also going to bring up the daily, and this is why I think that gold may be really in for a longer term bottom. Originally, back at these lows met in the end of 2011, this 525, wherever these lows were, let's see, what was it? 523, 524, that was the point of control for the year for gold. And now, or then, before this big down day, the point of control shifted up to this I want to say it was 1730, and then over the course of these last 2 weeks, the point of control for the year has again shifted to this 1660, 1665 level or so. And what we're looking for is to see if gold can get above those levels. If so, I would like to say that gold's going to make a run back up to what was the point of control for the year, which is 1730. That's going to make our position more than profitable. And if you want to take a speculative position, you can get more aggressive on the call spreads. And you can go out to, say, May, which gives you 50 days, and you could go currently trading at 1686, and let's get the GLD. Now the GLD is going to look a little bit different volume profile wise, but it's you want to go after the gold futures in terms of actual price and volume. So it looks like we can make a run up to 167 without a problem, potentially. So you could do something like a $4 spread. You could go 163 by 167, and if the risk-reward ratio is good enough, then I'm doing the math right now. Okay, for a $4 spread, you have call it $1.30 of risk. So it's better than the risk-reward ratio than we have on this current trade, the 161 by 164. But we're also buying a little more time, and we are your expectations are higher for the May trade. So I do think this position's going to work out. You have a lot of people who are short gold just from this recent move, and they're going to cover if it gets a little shaky. So it's just something to be aware of. And generally speaking, we're at the lower end of the range. We've stabilized pretty nicely at really in March at this lower end of the range. Now all we need to see is buyers start to come in. Right now I have a decent sized position in this, and I'm willing to add. So just let this thing work out, and I would say if you're buying for, what is it, $1.20 now, that's how much the spread's worth. Let it, give yourself 60 cents of risk to the downside. If you lose 60 cents, that's fine, because you were trying to make really $2.80. So it's I'm sorry, $1.80. So it's not bad at all, and that's really all there is to it. So let this work out. We have 22 days for it to do so, and on the GLD, this is where we have to get to, this 164 level where my cursor is. So it's not even that big of a jump. It's really just the top of this range that we've seen. So hope this works out. Hope you take this recommendation, because I think it will. And if it doesn't, remember, have your stop around 60 cents.